Many recently implemented stimulus measures, particularly in Europe, such as the so-called German defense investment plan, have yet to fully take effect and show their impact on the macroeconomic developments. And then we also see resilient fundamentals. Despite the surrounding noise, in fact, there have been no concrete sign of weakening in consumption or investment, indicating that business confidence remains pretty strong. The global macroeconomic environment today appears complex, but not without some positive signs. On one hand, there are still signals of deceleration, mainly linked to uncertainty surrounding US trade policy. And in this respect, a symbolic moment has certainly been Liberation Day, when the announcement of new tariffs triggered a negative market reaction and fueled widespread unease. The tariffs introduced a difficult to quantify risk variable that temporarily undermined investor confidence. However, as the market has gradually digested these measures, the true extent of their impact has become clearer. Many companies have shown a remarkable ability and resilience to absorb the negative effect, passing on only part of the cost to consumers through very limited and still sustainable price hikes. This has helped ease concerns on the market, especially for European exporters and for US consumer purchasing power. At the same time, markets are showing strong resilience. Recent economic data continue to indicate robust dynamics, starting with the US labor market, which has once again surprised on the upside. Earnings season has also provided some reassurance. In the US, in fact, Q1 earnings rose by 12%, supporting a rebound in equity indices and pushing the VIX index back to more moderate levels. In Europe, earnings, excluding the energy sectors, rose by 2%, a sign that fuels cautious optimism for the coming quarters. Geopolitical developments are also offering some relief at the moment, with trade talks between Washington and Beijing having resumed and leading this week to an agreement, while long-term yields have stabilized, easing pressure and concerns about the sustainability of US fiscal policy.
Currency dynamics remain central in the current environment. In recent months, the US dollar has experienced significant volatility, and the Trump administration appears to be leaning towards competitive devaluation to boost exports. In such a scenario, a new phase of dollar weakening is very likely, making it essential to analyze forex market direction carefully over the medium term. For European companies without a US production base, a weaker dollar can be a significant headwind. Revenue in local currency shrinks when converting back to euros, compressing margin and likely free cash flow. Conversely, US companies, especially those with a strong export orientation, could benefit from a competitive edge, both in terms of volumes and profitability. From an investment perspective, forex risk should not be underestimated. Its impact largely depends on the geographical makeup of the portfolio and the operational structure of the invested company. It is crucial to determine whether a company has a natural hedge, i.e. whether it generates both revenue and cost in the same currency. In the absence of this symmetry, exchange rate fluctuation can have a tangible effect on earnings and cash flow. That said, it's important to maintain a long-term perspective. Historically, forex has proved to be a variable that can both amplify and dampen performance, but is rarely been structurally decisive. For this reason, in building a well-diversified portfolio, forex risk is certainly something to monitor, but it should never outweigh fundamental company analysis, which remains the true long-term driver of value.
We believe the current favorable macroeconomic environment may persist for the coming month due to several reasons. First of all, policy incentives. Policymakers are strongly motivated to reach constructive outcomes in trade negotiations because nobody really stands to gain from a recession, including the United States. Secondly, market adaptation. Markets are gradually digesting tariff-related uncertainty, starting to view it not as a temporary shock, but as a structural component of the global economic landscape. Then we also focus on delayed stimulus impact because many recently implemented stimulus measures, particularly in Europe, such as the so-called German defense investment plan, have yet to fully take effect and show their impact on the macroeconomic developments. And then we also see resilient fundamentals. Despite the surrounding noise, in fact, there have been no concrete sign of weakening in consumption or investment, indicating that business confidence remains pretty strong. Market influence on policy is also a relevant factor, perhaps more subtly but decisively. Markets have become a shaping force in economic policy decisions. We have seen how governments and central banks are now quicker and more proactive to intervene to prevent excessive dislocations, signaling heightened sensitivity to financial stability. In 2025, US policy uncertainty has increased the risk premium demanded by investors, likely leading to a compression in valuation multiples. This could redirect capital flows towards regions perceived to be more stable or undervalued. First of all, Europe, which continues to represent a value market, with lower multiples compared to the US, despite the latter's still strong growth rates. A convergence of potentially favorable factors for Europe is now underway. There is a stronger growth appetite. Capital inflows may be coming from the US on the back of trade uncertainty induced by the current administration, and the prospect that expansionary fiscal policy could finally drive a real acceleration in the European economy certainly is a positive factor.